Welcome back to Corporate Finance. Last time we introduced the new topic, discounted cash flow analysis, by discussing how corporations, or people more generally, should be making decisions. We discussed several different decision criteria, focusing in particular on three: the NPV rule, the IRR rule, and the payback period. We also discussed how, in practice, we should be taking a practical approach and using the relevant information from all three rules. Today, I want to talk about free cash flows, a critical element in implementing any of those decision rules. Let's get started. Hey everybody, welcome back to Corporate Finance. Today we're going to start in on Lecture 2 of Discounted Cash Flow Analysis. But before doing so, let's do a brief recap of our last lecture. So we introduced the topic Discounted Cash Flow Analysis by discussing decision making. And we talked about several different decision rules used in practice, beginning with the NPV rule, which is nothing more than the difference between the present value of costs and the present value of benefits. And while most academics, including me, will argue that this is the best rule that you should always use, I take a practical view and recognize that other rules, such as internal rate of return and payback period, contain relevant information for decision making that, if used wisely and in recognition of their limitations, can lead to better decisions. And so that's sort of the overarching approach we're going to take to DCF, is that there are several different decision rules. We'll rely on NPV, but use what we can from other decision rules. Now, in this lecture, I want to talk about sort of the bedrock, or one of the key components of any DCF and any sort of decision making, and that's free cash flow. Specifically, what is it? So let's get started. So remember, there are two components to NPV. There are free cash flows and there's a discount rate, because NPV, as you recall from last time, is little more than just a discounted stream of cash flows. In this case, free cash flows. So recall, NPV was formally defined as follows, and we recognize that this is really nothing new. Right? This is what we've been doing all along. Okay? What I'm going to focus here is on the numerator, the free cash flows. How do we get at these free cash flows in a corporate setting, whether it's capital budgeting or valuation more broadly? How do we compute these FCFs? That's what this lecture is really about. So let's take a look. Free cash flow begins with revenue, or sales. We subtract off costs, and then we subtract off depreciation, actually depreciation and amortization, but mostly depreciation. Depreciation or amortization, both. Now you might wonder, well, first, what is depreciation? Depreciation is just a accountant's way of recognizing the loss in value, the deterioration in value of physical assets like plants and equipment. But it's sort of an accounting notion. It doesn't represent a true cash flow, right? When a plant depreciates, it's not as though money is leaving the company. So you might wonder why we're even considering it. Well, the reason we're considering it is because we're going to take this term in parentheses that I've now bracketed and multiply it times 1 minus TC. TC is the marginal tax rate. Okay. See, even though depreciation doesn't represent any dollars flowing out of the company or away from a project, it's not a literal cost in terms of dollars, what it does is it does reduce our taxable income. It provides a tax shield. And so we have to take that into account when computing free cash flows, because taxes are actual dollars leaving the company or the project. Okay. Now, this quantity here goes by several names. They're all synonyms. Unlevered net income, net operating profit after taxes, or NOPAT, or earnings before interest after taxes, EBIT. Once we have this, we're going to have to add back in depreciation. And again, that's just to net out the subtraction of depreciation here. Right? It doesn't represent a true cash flow. What it does represent is a tax shield. So we add back in the depreciation. Then we're going to subtract off, get rid of that, capital expenditures or any investments we have to make. And then finally, we're going to subtract off the change in net working capital. And that sometimes throws people for a little bit. What do you mean subtract off the change in net working capital? Well, first, what is net working capital? Well, net working capital, NWC, is equal to current, that's supposed to be a U, current assets minus current liabilities. And current assets, that's loosely cash plus accounts receivable plus inventory. Okay. And current liabilities, we're going to focus on accounts payable. Now, some of you might say, what about short-term debt or long-term debt that's coming due? That's financing. Leave that aside. That's a separate issue. We'll talk about that a little bit in a little bit. Okay. So what goes into the free cash flow calculation is not net working capital. The change is important because these are all what economists call stock variables, and we're trying to compute flows. So we want to look at the change, the period over period change in net working capital, and subtract that from free cash flow. So what is free cash flow intuitively? Well, it's the residual cash flow that's left over after all of the project's requirements have been satisfied and the implications accounted for. It's the cash flow that can be distributed to the financial claimants of the company, debt and equity. That's another way to view it. It's not the same as accounting cash flow from the statement of cash flows, but we can derive free cash flow from the statement of cash flows, actually with just a few steps. Now I want to be precise here. The free cash flow we're going to compute here, or is defined right here, this is unlevered free cash flow. And I say unlevered to distinguish it from free cash flow to equity or levered free cash flow, which we'll discuss on the next slide. Okay. So free cash flow to equity starts with free cash flow, the definition of free cash flow. That's just this quantity right here. And then we've added, we've appended two terms. We're going to subtract off the after-tax interest cost and add back in any net borrowing, that is borrowing above and beyond any repayment of debt. So another way to compactly write the free cash flow to equity is that it starts with unlevered free cash flow, the free cash flow available to debt and equity holders, and we subtract off the after-tax interest expense and add in the net borrowing. So what is free cash flow to equity? It's the residual cash flow left over after all of the project's requirements have been satisfied, implications accounted for, and all debt financing has been satisfied. That's critical. We take care of the debt holders first because they're senior claimants. Free cash flow to equity is the cash flow that can be distributed to the shareholders, i.e. equity holders of the project or the company. And free cash flow to equity, this should be E, there we go, is more precisely levered free cash flow because free cash flow to equity is affected by the company's choice of financial structure. It's a leverage decision, how much debt it plans to take on. So let me show you this, what we've just discussed schematically in terms of a hierarchy that's kind of getting us a little bit close to an income statement, right? Remember, free cash flow starts with up at the top with revenue. We're going to pull out the depreciation. The revenue comes in. We're going to pull out the depreciation and costs. We're going to pull out our taxes. Okay? That's going to give us our unlevered net income. This is our NOPAT or our EBAT. Then we're going to add back in the depreciation because it's a non-cash expense. And again, that could be depreciation and amortization. We're going to subtract off our capital expenditures, our investment requirements. We're going to subtract off our investment in net working capital the change in net working capital, and that's going to give us our unlevered free cash flows. These are the cash flows that can go to debt holders and equity holders. Then we're going to subtract out our after-tax interest expense. And I say after-tax because remember, interest is tax deductible, right? It provides us a tax shield. And then we're going to add back in any net borrowing. So if the company borrows some debt in excess of what it repays, that's a cash inflow that's available for use by the equity holders. And what we're left with down here at the bottom is the levered free cash flow, or the free cash flow to the equity holders. So strategic decisions, a useful way to think about strategic versus financial decisions is that strategic decisions are going to affect the inputs to free cash flow, well, and free cash flow to equity, but they're impacting here, right? Strategic decisions are going to affect our market share and our revenue. They're going to affect our cost, our investment decisions, right? Investment decisions, our operations, inventory and the like. All of these strategic decisions are going to impact our unlevered free cash flow and ultimately our levered free cash flow. Right? Financing decisions are down here. They're going to impact our leverage choice, the after-tax interest expense, the net borrowing. Okay? And hence, that's why we refer to these cash flows here as unlevered. They're unaffected by leverage choices. Now, strictly speaking, that's not always true. In more advanced valuation courses, you might see financing decisions feeding back on some of the inputs into unlevered free cash flow, such as the ability of a firm to invest or its revenue growth. But a useful benchmark and a common benchmark is just to recognize that financing decisions do not affect the unlevered free cash flow. And that's a great way, by the way, to check your computations in any sort of valuation or DCF exercise. At least one way is by recognizing that financial policy is not going to hit the unlevered free cash flows. All right, so let's summarize this now. Okay. NPV is a decision rule that's going to quantify the value implications of decisions. That's what we learned last time. And there's two key components to it, right? There's free cash flows and discount rates. This lecture was all about how do we put some meat behind that FCF term? How do we actually compute it? How do we derive it for a project or a firm, more broadly speaking? And what we saw is that there's a relatively simple formula for computing free cash flows, and don't be misled by its simplicity. It applies broadly. We can always use this definition. The trick in practice is actually estimating the components and figuring out what hits unlevered free cash flow versus levered free cash flow, what's relevant for cash flow, what's not relevant for cash flow. And the remainder of this topic is going to be geared towards answering those questions in the context of an actual example. So coming up next, we're going to start in on forecast drivers, or trying to understand how we're going to forecast each of those components of free cash flow out into the future. Thanks so much. Welcome back to Corporate Finance. Last time we introduced free cash flow. We talked conceptually about how to compute free cash flow. Today, what I want to do is I want to introduce a capital budgeting application to illustrate discounted cash flow analysis. And in particular, what I want to do is emphasize the role of forecast drivers, or the assumptions we need to forecast free cash flows out into the future. Let's get started. Hey everybody, welcome back to Corporate Finance and our third lecture on the DCF topic, forecast drivers. Let me start with a brief recap of what we talked about in our last lecture, which was free cash flow. In that lecture, we talked about what free cash flow is, how to compute it. We formalized it. We actually gave it a specific formula. We also talked about free cash flow to equity, the levered counterpart to free cash flow, or more precisely, unlevered free cash flow. And what I want to do in this lecture is talk about forecast drivers, or the assumptions required to forecast each component of the free cash flow formula out into the future. And we're going to do it by way of a specific example. So let's get started. So imagine we're a company in, say, 2008, and we're considering building and selling a tablet. And so back in 2008, this was really just the start of the tablet market. So I've put our free cash flow formula up here to highlight the components that we're going to need. And remember, the question is, should we enter this market? Should we produce and sell this tablet? Well, to make that decision, what we're going to want to do is a DCF, and we're going to want to forecast each component of this free cash flow formula into the future. So let's do that. We're going to start with revenue. So revenue is market size, how big the market is in terms of units, times market share, what proportion of the market we're going to capture, times our price per unit. So let's look at our forecasts here. So I'll start with the market size. Okay, now I'm going to assume that in the first year the market size is going to be 1 million units. That's going to be the early adopters, the techies, the people who are really excited about new technology and the introduction of new technology. So that's going to be 1 million units in year one, but that's then going to grow quickly in subsequent years. And you might say 2,500%, that's ridiculous. And it's an absolutely enormous growth rate for sure. But remember, this is the beginning of a new market that we're anticipating will take off in a big way. All right, so 2,500% in the second year, followed by 128, 9.4, and 3.5%. Now you might wonder, where in the world am I getting these? Well, I'm getting them from a variety of different sources. I'm getting them from my marketing people and my strategy group within the company. I'm getting them from industry analysts as well. So there's a host of different sources of input that go into these numbers, but at the end of the day, they are just assumptions, and I'm going to emphasize that fact later on. So I can use these two assumptions about the market to compute a market size in terms of millions of unit, right? Just 1 million in the first year. That's going to grow by 2,500%, 128, 9.4, 3.5. So that's my forecast for the size of the tablet market. Now what's interesting, what I'm going to show you in this next slide, is here is the actual market size for tablets. And what you can see, even with a 2,500% growth rate, I was conservative in my estimate, right? 26 million as opposed to 60 million in sales in the second year, followed by 116, 195, 229. So not sales, the actual size of the market. So you can see this market took off incredibly rapidly. All right. Next, I want to look at my market share. I'm going to assume an initial penetration of 25%, followed by annual growth of 5% each year thereafter. That's going to allow me to forecast my market share, which I bring down to 25%. That's going to grow at 5%, 5%, 5%, and 5%. So this is, just to be clear, 25% times 1 plus 5%. That'll get you the 26.3%. And likewise for the subsequent forecasts. And finally, we have to come up with a pricing strategy. I'm going to price our tablet initially in year one at $200 per unit, which I just bring down here. I'm not going to experience any price change in the second year, but then I'm going to increase prices in the third year by just under $50. Now you might wonder, what am I thinking? Consumer electronics prices go down, and go down fairly rapidly. But what I'm going to do is I'm going to build in some element of versioning here. So just like we had the iPad, iPad 2, iPad Air, I plan on doing some R&D, which I'll discuss later, that's going to develop new, better versions, lighter, more powerful, better screens, etc. So that's going to justify an increasing unit price over time. Let's move on to costs. So I'm going to start with COGS, or costs of goods sold, which I express as a margin here, or a percentage of sales. And I'm going to assume that's going to run at about 80.66%, a number based on our company's experience working in the computer industry for some time, based on estimates from our operations people and insights from other analysts and consultants. My SG&A, sales, general, and administrative expenses, are going to run at about 1% of my current SG&A, or $69.59 million. I'm just making that number up. Bear with me. Okay. So it's going to be $69.59 million in the first year, and I'm going to assume that's actually going to grow by 25% per year. Because hopefully as sales and the size of this market grows, I'm going to have more overhead to keep up with that growth. Whereas I'm tying COGS, which is loosely viewed as a variable cost, I'm tying that forecast to sales. Okay. Now, R&D, well, I'm going to have to spend $200 million up front in R&D to get this thing up and running. Right? And then I'm going to have an additional 25, so that's this upfront R&D. Then I'm going to have an additional $25 million every year thereafter to deal with versioning and improvements. Now let's turn to our investment needs. I'm going to assume an upfront investment of $227.7 million to build a plant, get any necessary equipment for production. My first year investment is going to be 10% of that initial investment. And then subsequent years are going to be annual growth of 5%, and then 1, 1, and 1. Okay? And you'll see how this rolls out in the next lecture when we actually forecast those free cash flows. Okay? But these are just the assumptions. We're laying the groundwork here. Now, at the end of this project, which is 5 years, right? So I'm going to assuming that this is a 5-year project. At the end of this project, I'm going to have all of this plant, property, and equipment left over. Well, let's focus on the plant and equipment. It's going to be there. It's not going to just disappear at the end of the project. So I'm going to assume I can do something with it. I could sell it. I could rent it out. I could redeploy it for another product. But I'm going to take a step back from precisely what I do with it and just assume a liquidation value or a valuation for it that in which I get 50 cents on the dollar. Okay. It's just an assumption. Now, for depreciation purposes, I'm going to assume that all capital depreciates on a straight line over 5 years. That is, its useful economic life is 5 years. And so each year, 1/5 of the capital theoretically disappears. Again, that's a non-cash expense. It's not costing me anything, but it is going to provide a tax shield here that we have to recognize. So we need to understand what our depreciation is going to be. Now, on to net working capital. Recall, net working capital is cash plus inventory plus accounts receivable minus accounts payable, accounts receivable, accounts payable. Okay. Let's go after each component here. I'm going to assume this project is going to require a certain amount of cash, which might seem a little bit odd, but think of it as cash that I need to pay employees and ongoing bills such as utility costs, IT expenses, whatever it may be. And those requirements are going to be defined by 50% of my SG&A and 100% of my anticipated R&D expenditures. Let's clear that. There we go. My inventory forecast is based on inventory days or turnover. How long does it take to get inventory in and then out? I'm going to assume that that's 7.58 days, which, by the way, is very fast. You have to look to a company like Dell for that kind of turnover. Okay. And finally, I want to recognize that at the end of this, I'm going to have some inventory left over, which I assume I can get 25 cents on the dollar. At that point, it's going to be fairly obsolete. I might want to scrap it. I might want to sell it on some secondary market. Sorry about that. Some secondary market. So I'm going to assume 25 cents on the dollar for that remaining inventory at the end of this project. Okay. My accounts receivable are based on days receivable, or how many days it's going to take until I actually get some money in following a sale, because remember, a lot of sales are based on credit. And likewise, my accounts payable are based on days payable, which is going to tell me roughly how long it takes for me to pay my suppliers. You know, I might be paying them using trade credit. Okay, so that's our working capital, but remember, what we want is the change in net working capital. So while excuse me, well, these forecasts here, well, all of these forecasts here will get me my net working capital. What I'm going to want to look at in free cash flow is the year-on-year change from year T minus 1 to year T. And then the last piece of this puzzle is taxes. Right? I want the marginal tax rate. I want the tax rate on an additional dollar of earnings. I'm going to assume that's 25.5%. Okay. A lot of people will estimate this with an effective tax rate, that is, looking at the income statement, tax expense over pre-tax income. That's not, strictly speaking, what we want. To get at the marginal tax rate, you probably need access to the tax records of the company, which are difficult, if not impossible, to get. So a lot of people will also assume a top statutory corporate tax rate of around 35, 36%. Okay. All right, so what we've done is we've gone through, let me just wrap up a little bit here. We've gone through and we've produced or made assumptions about every component in our free cash flow formula. And all of those assumptions are going to allow us to forecast dollar values into the future. Okay. But let's take a step back. This is nonsense. That's a common look I get from students or practitioners when I discuss this, this framework, because the argument is, look, this is impossible to make accurate forecasts in the future. It's hard enough to figure out what our company is going to do and how the economy is going to change and how that's going to impact our company a quarter out, much less 5 years. And I agree, but I think that's not the point. Let me be clear on what I agree. It's not that this is nonsense, but I do agree that it's very difficult, if not impossible, to make accurate forecasts. But that's not the point. That is just not the point of a DCF. The point of a DCF is really to focus the discussion and analysis on the relevant issues, to get away from decision making based on gut feelings, what the stars look like, whether it's a full moon, other ad hoc rules of thumb, just referring to nebulous experience and I know best, or I've been at the company for 20 years, this is the way it is. DCF provides a rigorous framework within which we can discuss what really matters for value creation. And that's the whole point. That's what I want to emphasize. The goal of a DCF isn't to get one number that we argue is correct. The goal of a DCF is actually to provide a host of numbers and a host of sensible and financially correct information from which we can make better decisions. And I'm going to emphasize that throughout. Another lesson I want to emphasize here is that no successful valuation or DCF can rely solely upon input from financial personnel. It's critical that we get input and insights from all aspects of the company or across division lines. I mean, think about what we're forecasting. We're forecasting revenues, what's going on with the market. So we want to talk to our marketing and strategy people. We're going to be talking about investments and operations. We need to understand what our inventory is going to be from our operations people, from line managers, even from lower rank and file employees. That's how you build a successful valuation. That's how you build a successful DCF model with really good inputs from knowledgeable people. All right, let's wrap this thing up. So today we discussed forecast drivers in the context of a specific example, that being a tablet. And these are nothing more than the assumptions that we're going to use to forecast the dollar values of each component of our free cash flow formula. And again, the goal isn't to get the right answer, it's to provide that framework within which we can discuss sensibly and logically the relevant issues for making decisions. So in the next lecture, what I want to do is I actually want to use these forecast drivers to forecast the free cash flows, the dollar values. I look forward to seeing you then. Welcome back to Corporate Finance. Last time we talked about forecast drivers, or the assumptions required to forecast free cash flows into the future. Today, I want to apply the forecast drivers we discussed last time in the context of our tablet case and apply them to the free cash flow formula to forecast free cash flows into the future for the tablet project. Let's get started. Hey everyone, welcome back to Corporate Finance. Today we're going to be talking about forecasting free cash flows, but before doing so, let's start with our recap of the last lecture. Last time we laid out our forecast drivers, and those were the assumptions that are necessary to generate our free cash flow forecasts. In particular, they're the assumptions about each of the components going into our free cash flow formula. Today, I want to apply those forecast drivers to actually forecast dollar cash flows, dollar free cash flows over the 5-year horizon for our tablet project. So let's get started. So here's our free cash flow formula. And again, the goal today is to translate the forecast drivers into dollar forecasts. So as a brief reminder, here are our revenue forecast drivers. We're going to start by forecasting the dollar revenues. And we know that revenue equals market size times market share times price. So for year one, our revenue forecast is just going to be the year one initial market size, 1 million units, times our share. We're going to get 25% of that market. And then we're going to multiply it by our per unit price of $200 for a revenue forecast in year one of $50 million. If we repeat that process for years 2 through 5, we'll get our revenue forecasts for all 5 years. And there they are. Now let's move on to costs. Right? And we'll start with COGS, cost of goods sold. You can see that our forecast drivers here are expressed as a percentage, and in particular a percentage of sales. So I'm going to repeat the sales forecast from the last slide here because we're going to need them to get at COGS forecasts. So if we look at year one, we can see that 80.66% of the sales are assumed to be cost of goods sold. So we take our $50 million revenue forecast, multiply it times that 80.66%, and out pops an estimate or a projection of cost of goods sold in the first year of $40.33 million. If we repeat that process through years 2 through 5, we're going to get a full-blown COGS forecast over the entire projection period. Now let's move on to SG&A, still in the costs category. Here we've assumed a first-year SG&A expense of $69.59 million. Now it's in dollars already, so there's not really anything to do. It was just an assumption I made based on 1% of the 2008 company-wide SG&A expense, a number I essentially made up just for illustrative purposes. But going forward in years 2 through 5, we're going to assume that SG&A expense grows at 25% per annum. So to get year 2, for example, we start with our $69.59 million expense in year 1, and we compound it up by 25% to get an estimate of $87 million for our second year SG&A expense. And if we continue with that 25% annual growth, we're going to get an actual SG&A series here. Finally, moving on to R&D, there's really not much to do here because I've assumed dollar forecasts both for the upfront R&D necessary to get the project off the ground, as well as the subsequent R&D required for any versioning. So here are our R&D dollar forecasts. I'm going to take a step back and put this together into a somewhat familiar format, and we're going to start with the top line sales forecasts right here. I'm going to subtract off my COGS to get at gross profit. I'm then going to subtract off my SG&A expenses and my R&D expenses to get estimates of EBITDA. And EBITDA is a mouthful once you say it. It's earnings before interest, taxes, depreciation, I'll abbreviate that, and amortization. Okay. Now let's move on to capital expenditures. So our upfront investment is going to be $227 million, well, a little over $227 million for the plant and the equipment. Then we're going to invest in the first year of the project 10% of that amount, followed by annual growth of 5%, 1%, 1%, and 1%. So, to get our dollar forecast, there's nothing to do for year 0. That's just the $227 million. For year one, we're going to take 10% of that $227 million to get $22.77 million. And then for let me clean that up a little bit. For year two, we're going to grow that at an assumed 5%. So we compound up the $22.77 million at 5% to get an estimate or a forecast of capital expenditures in year two of $23.9 million. And continuing that growth process for years 3, 4, and 5, okay, right, at 1%, we're ultimately going to arrive at our projected capital expenditure series. There it is. Now, we're going to assume we're going to straight line depreciate this capital expenditures over 5 years. What that means is 1/5 of the capital stock is going to depreciate each year. Right. So what I'm going to do to make things a little bit easier is I'm going to create a row of accumulated capital expenditures, right? So that's nothing more than the current plus all previous capital expenditures. So this 250.5 is the 227 plus the 22.8. The 274.4 is the 250.5 plus the 23.9, and on and on and on. And the reason I'm doing that is to avoid keeping track of different vintages of capital stock, since they all face the same depreciation schedule, at least by assumption. And what I can do to compute the depreciation is simply divide last year's accumulated capital expenditures by 5. So the 45.5 in year one comes from 227 divided by 5. Year 2, 50.1 comes from the 250.5 divided by 5. And again, all we're doing is, what's really going on is this capital stock is depreciating by another 20%, and then this depreciates by 20%. So we add those two to get the 50.1. And we continue that on, and we're left with, we get our depreciation series. Now, here's a question. What happens to all of this physical capital at the end of the project, at the end of the 5 years? It certainly doesn't evaporate, right? It doesn't disappear. We can sell it, or we can redeploy it in for another purpose. So we need to recognize that. Okay? Otherwise, we're going to underestimate cash flows. Okay. So what I'm going to do is I'm going to take that, all of that capital expenditure, that accumulated capital expenditure, and I'm going to subtract from it the accumulated depreciation. That is, I'm just going to sum up all of the depreciation to get this 274.8. The difference between the accumulated CapEx and the accumulated depreciation is the book value of the assets, or $72.8 million. Okay. Now, I'm going to assume that I can't sell that on a dollar-for-dollar basis. Rather, I'm going to have to sell it at a discount, 50 cents on the dollar. And so the liquidation value, the money I can actually get for it, which is different from the book value, is assumed to be $36.4 million. But remember, we have to deal with taxes. And so what we're really interested in are the after-tax proceeds from selling this. So we're going to get $36.4 million, but we're going to experience a book loss because the value for which we can sell the assets, by assumption I might add, this isn't always the case, is less than the book value of the assets. I multiply that times the tax rate, so we get a little bit of a tax shield here from our loss. And the result are after-tax proceeds that are actually greater than the liquidation value. We're going to get $45.6 million. And so the end result is that we have our projected capital expenditures here, but once I factor in the after-tax proceeds from the sale of these assets, we're actually going to have a negative capital expenditure in that last year, that 5th year, which is going to reflect an inflow of money. So now let's turn to net working capital, more precisely the change in net working capital, but we'll start with net working capital, which is, you remember, is cash plus inventory plus accounts receivable minus accounts payable. And here were all of our assumptions, all of our forecast drivers for the components of net working capital. Let's start with the top, the cash requirements. We're going to require 50% of SG&A in cash and 100% of our R&D expenditures. So we're going to need our SG&A forecasts and our R&D forecasts to back out the cash requirements. Notably, for year one, we're going to need 50% of our SG&A expenditures, or $34.8 million, held in cash. But we're also going to need 100% of our R&D expenditures, 100% of the $25 million, or $25 million. We're also going to need to hold that in cash. Right? So our cash requirements are the sum of these two and are given by this row. And again, we're just going to repeat that, year by year for 2, 3, and 4. Turning to inventory, our forecast drivers lay out the days, the inventory days, but the inventory days are based on COGS, so I'm also going to need my COGS series, which I've put here for convenience. So to compute the first year inventory requirements, I'm going to take my days in inventory, 7.58. I'm going to multiply that by my COGS expenses, and I'm going to divide that by 365 to get an estimate of first year COGS at $837,000. If I keep doing that year after year, we'll get our inventory requirements. Turning to accounts receivable, we've got days receivable assumptions. Those are based on sales, so here's my sales, forecasted sales. When I apply the days receivable to the sales, say for year one, for example, I've got 38.49 days receivable times the $50 million sales forecast divided by 365 days, gets me a forecasted or projected accounts receivable of $5.2 million, a little over $5.2 million at the end of year one. We continue that process for years 2 through 5. And there's our accounts receivables projections. And finally, we turn to accounts payable. I've got days payable assumptions of 61.54 days. This is based on COGS, so here's my COGS series for convenience. I apply my days payable forecast to our forecasted COGS series, and out pops the accounts payables forecast. Okay. Repeating that process again, years 2 through 5. We get our accounts payable. Oh, there's a typo. We get our projected accounts payable series. And we can put this all together, our cash inventory, accounts receivable, and accounts payable forecasts, to compute net working capital for each year. Remember, it's going to be cash plus inventory plus accounts receivable minus accounts payable. That gets us our net working capital. But here's a question. What happens to all this working capital here at the end of the project? Specifically, what happens to all the cash that's sitting there, or the inventory, or the accounts receivable, the customers from whom we're waiting to receive payment, or the accounts payable, the suppliers who are awaiting our payment? What happens to all that net working capital? Well, like physical assets, it doesn't just disappear. In fact, most of it is going to be recovered. Not all of it, and I'll explain why in just a second. In particular, right, we're going to be able to recover the cash. We're going to be able to recover some money from the inventory, but by assumption, back in our forecast drivers, we're assuming we're only getting 25 cents on the dollar for this inventory that is probably obsolete and either not worth much in terms of scrap or on some sort of secondary market. We're going to have to pay, we're going to have to pay all of our accounts receivable, but we're also going to have to collect, let's get rid of that. We're going to have to pay our accounts payable, and we're going to have to collect our accounts receivable. The upshot of this is we're going to recover $51.375 million in net working capital at the end of the project. Okay. So our change in net working capital, remember we're interested in the year-on-year change, is given by this row. Let's just briefly discuss it. Get rid of that guy. So the first change is 59.1 minus 0, which is 59.1. Okay.
The second change is the 49.7 minus the 59.1 gets me minus 9.4. And on and on and on. And in the last year, we would have 25.6 minus the 28.2, but then we have to add back in the 51.3 to get net working capital of 48.6, which reflects recovering all that working capital at the end of the 5th year. Now, there is a bit of an assumption, well, there's a lot of assumptions, but one of the assumptions here is that we're recovering all the working capital right at the end of period 5. In reality, you're probably going to collect that within or during year 6. So I could have extended this to a 6th year, but it's not going to make too big of a difference. The discounting effect is going to be small, so I just wrap it all up in this 5th year here. We have all the pieces now, right? And what I want to do first is organize them into a useful and familiar format, what I'll call a quasi-income statement. And it's a quasi-income statement because it's missing an important item and it's applying taxes slightly differently. I'll explain that when I get there. So we start top line with sales, subtract off COGS, that gets us gross profit. We're going to subtract off our SG&A, subtract off R&D, that gets us our EBITDA. And sorry, ignore these numbers here. What they are, they're references to rows in the spreadsheet. They're just a useful way to keep track of things. We're going to pull off our depreciation. That's going to get us our EBIT. We're going to apply our tax rate to our EBIT to get our tax expense, which we subtract from EBIT to get our NOPAT. Now, I call this a quasi-income statement because what's missing here is interest. No interest. That's financing. We're after unlevered cash flow, so that's not relevant here. It's also quasi because the taxes are applied to EBIT as opposed to pre-tax income, which comes after interest. Okay. Right, so this is our NOPAT series. Let's carry that NOPAT forward up to here. Add back in depreciation, subtract off capital expenditures, and subtract off the change in net working capital to get what we're really after, or ultimately after, which are free cash flows. These are the free cash flows to the project. Now, some other things to keep in mind when you're going after free cash flows. First of all are opportunity costs, alternative uses of resources, right? They're not free. Second, project externalities, and this is a biggie. In our context, you can imagine that the tablet might cannibalize or take away sales from other product lines, maybe desktops, for example. You also want to be cognizant of spillovers. You could imagine that in the process of developing and selling this product, this tablet, we might learn something about our production process that applies to other product lines. Or it might lead us to the development of an entirely new product line. We need to recognize these externalities that are associated with this project. Sunk cost, ignore those. What do I mean by sunk cost? Well, imagine we commissioned a marketing study back in 2006, 2 years before we were valuing this project or deciding on this project. The costs associated with that marketing project as of 2008 are completely irrelevant. They're sunk. They're irrelevant for our decision making. All that matters are the costs going forward and benefits. Other non-cash items such as amortization, we have to take that into account, particularly because that generates a tax shield, but also other non-cash items like stock-based compensation, stock grants, restricted stock awards, options, employee stock options, and the like. Salvage values. We touched on this in this lecture, right? Assets don't just disappear, and neither do liabilities. So we have to take into account any salvage values or liquidation values associated with our assets. Execution risk. Look, this is a risky project, but the way we're going to capture execution risk, that is risk unique to this project, is not through the discount rate, and I'll come back to talk about that more later on in the class when we get to estimating the discount rate. But this is specific to the project, so it's got to affect the free cash flows. And the way it's going to affect that is we're going to look at expected free cash flows. That's the way to think about the numerator in the NPV calculation. And we can also capture this through sensitivity analysis by looking at different scenarios, different forecasts for free cash flows. That's going to come up in a little bit when we talk about sensitivity analysis. And one last point is, I've assumed an annual frequency here, but there's nothing special about that. We could have done this on a quarterly frequency. We could have done it on a monthly frequency, semi-annual. Take your pick. What determines the cash flow frequency is really the situation. It's project dependent and it's sector dependent. So don't think there's anything special about annual frequency. We know how to deal with non-annual frequency cash flows and discounting them, so it's not a problem at all. All right, let's summarize this. What we did in this lecture is we actually forecasted the dollar values of the free cash flows. And the way we did it is we built it up from our forecast drivers of the components within free cash flows. This is one of the two basic inputs into a DCF, the other being the discount rate. And the question now is, what do we do with these free cash flows? Well, that's the topic of our next lecture, where we take a look at decision criteria. So thanks for listening, and I look forward to seeing you in the next lecture.